Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, December 16th, 2022. So we said at the beginning of the week, this is a huge week as it relates to macro catalysts, all the key macro variables, PMIs, hard data in the US, hard data in China, jobless claims, got the Fed, the Bank of England, the ECB, everything. Oh, and by the way, CPI on Tuesday. Everything happened this week. And guess what? It was not a good week for speculating in risk assets. I think we learned a lot about sort of the near-term outlook for policy, both with respect to these DM central banks. I think we also learned incremental information with respect to growth. Starting to maybe look less boomy from a coincident and lagging indicator perspective in the U.S. Obviously, Chinese growth is a disaster, which we'll highlight here in our economic release spotlight. So, with respect to Chinese growth, and this came out Thursday. We didn't have a macro minute yesterday, so I just wanted to expound upon this because I think it's one of the more underappreciated stories in all of global macro right now. So I'm keen to present it to you this morning. So we got China's hard data for the month of November. Again, these data points came out overnight Thursday. Retail sales slowed 540 basis points to minus 5.9% year over year. That's the lowest print we've seen since May. Industrial production slowed 280 basis points to 2.2% year over year. That's the lowest print we've seen since May. Fixed asset investment growth slowed 50 basis points to 5.3% year over year, year to date. That's the lowest print we've seen since December and the sharpest deceleration we've seen since May. And that deceleration was primarily driven by the ongoing contraction in real estate fixed asset investment, which slowed 100 basis points in November to minus 9.8% year over year, year to date in November. That's the lowest print we've seen since February of 2020. That is the trough of China's initial COVID lockdown. So we're also seeing some weakness in first-year home prices as well. So that slowed 20 basis points to 2.5% year over year. That's the lowest print we've seen since November of 2018. So very clear. The Chinese growth dynamic is really, really negative. And I think a lot of investors are writing this off as zero COVID. But the reality is there was no issue with respect to zero COVID in the month of November in terms of incremental issues and lockdowns. We're going to get that. We were going to get that this month, but they obviously relaxed testing, relaxed a lot of the COVID restrictions this month, so we're not going to see any lockdowns. The reason I'm calling this China data out specifically is because it's more evidence of the liquidity cycle downturn we've been calling out in China. One thing we track as a catch-all for all the various means and measures that the PBOC uses to influence monetary policy in China is the 3-month Shibor. And the reason we track 3-month Shibor as that critical proxy is because 80+% of private non-financial sector credit on the mainland resides on bank balance sheet. It's not like the U.S. or Europe, which have burgeoning shadow bank sectors. So tracking 3-month Shibor, we've seen it bounce roughly 75 basis points over the last couple of months or the last 3 months. And that, in our opinion, is a function of the liquidity cycle downturn that we're experiencing in the U.S. Don't forget, China is a very dollarized economy, even though we don't think it is because of its closed capital account. Don't forget, China is the world's largest non-U.S. Borrower of dollar-denominated credit at just under $600 billion. And moreover, that $3.1 trillion that the PBOC is sitting on with respect to China's FX reserves are effectively capitalizing the entire monetary base because there's a closed capital account. This is something that's been consistent throughout my career, which is China has consistently imported easy and tight monetary conditions from the U.S., and that remains ongoing. This is why they want to get off the dollar reserve system, because they know that they're not truly in control of their own monetary policy. We saw this in 2010, 2011, when we went to QE. I was writing notes about this back then, October 2010. We got off QE, or we went to the tapering of QE2, and that caused a significant contraction in Chinese monetary conditions throughout 2011. We saw it in 2013 as well. We saw it 2015 to 2018, and then now we're seeing it now. And so this is the fourth cycle again throughout my career. I've been doing this for about 14 years now, and that I've seen. Hey, look, whenever the Fed gets tight, China's not far behind because again, it's a dollarized economy, even though it technically doesn't feel that way. So I just wanted to call that out because again, this concept that China is going to reopen and everything's going to boom, I think really got sort of punched in the mouth by that data. And the reality is that data is just indicative of the fact that, hey, look, the Fed is going to be tighter for longer. And as a function of that, you might have the PBOC being forced to be tighter for longer, irrespective of what happens on zero COVID. Obviously, zero COVID is delta positive for growth. We just may not get to the levels of growth, Chinese growth, in a quote unquote fully reopened Chinese economy that I think some investors might have thought going back prior to the release of that data. So hopefully that's helpful. We talked about that. We talked about the Bank of England, ECB, unpacked some of the U.S. hard data in our morning note this morning. Also had some more, gave some more thought to our revised bottom-up macro regime and top-down market regime summaries in that note. So definitely go check that out if you're a subscriber. And if you're not a subscriber, guess what? That's why you're watching the free program. Anyway, getting into my Lombo dashboard here, starting with global macro. Bloomberg Dollar Index, that is bearish on both short and medium term on a basis in terms of momentum. We're getting towards the upper bound of probable range. Will that thing start to slope up, or are we still in this sort of bearish breakdown of dollars? That, to me, it's the most critical factor to watch this week. Obviously, we saw both the euro and British pound get smoked in the wake of the ECB and Bank of England meetings yesterday, which clearly weren't hawkish enough in our opinion. So maybe we've put a floor in the dollar with respect to kind of a medium term perspective. Gold, bullish on both, inverse of the dollar. Obviously, perhaps we put in a immediate term or a local high in gold for the time being, to the extent the dollar starts to climb higher. 10-year Treasury yield, that's been bullish or bearish from a short-term momentum perspective, neutral from a medium-term perspective, right in the middle of the range. S&P 500, that's neutral on both durations, getting towards the lower boundary of the range at around 3,900, let's call it. It's OPEX. We got quad witching or triple witching or whatever witching we have here, big chunky OPEX. So, I wouldn't read too much into anything that happens today. You might actually get a bounce on Monday as, some of the kind of rehedging and rolling down and out of strikes that occurs today kind of gets unwound, and you might be able to get a little relief rally next week. But again, we would be fading that relief rally in the context of what we believe to be misguided seasonality views. VIX, neutral from a momentum standpoint, bearish from a medium-term standpoint, right in the middle of the range there. So kind of snitching on the S&P signal, if you will. It's effectively saying, hey, look, this lower boundary of the probable range may actually start to slope down in the context of a VIX that is not yet overbought. NASDAQ 100 neutral on both short and medium-term durations. That's similar signal to the S&P. I wouldn't read too much into looking oversold here. I mean, it may be oversold tactically in terms of trying to play for a Monday, Tuesday OPEX, post-OPEX bounce. But again, we would be fading that pretty aggressively early on. Russ 2000, same deal with the NASDAQ and SPY. Bitcoin neutral from a short-term perspective, bearish from a medium-term perspective, right in the middle of the range. Same deal with Ethereum. China, bullish on both durations from a momentum standpoint, getting towards the lower boundary of the range there. So if China, China will perform if it comes out of zero COVID. In fact, I would argue it pretty much is out of zero COVID. They scrapped testing. So now we got, Omicron bursting through the Chinese population right now. And so in about a month's time, China will be a fully reopened economy, just given the historical experiences that we experienced with respect to the Omicron variant. So, China's going to be going in a positive direction from that nasty growth data I just highlighted. But again, the speed of the change might be disappointing, and the levels of Chinese growth on the other side of this wave we're going to get might be disappointing. And oh, by the way, Chinese growth might actually slow here again in December, just given the fact that the whole country will be some version of self quarantining because they're sick, not because the government is telling them to. And then lastly, crude oil, bearish on both durations, kind of in the middle of the range there. We shall see with respect to crude oil and China reopening, although we have seen evidence of China stockpiling commodities. So at least the initial phase of the reopening process, which again probably leads to more shutdowns, not less, in terms of people being sick, might be bearish. But then at least the on the outset of that, looking into the Q1, Q2 of next year, you might actually start to see China demand more commodities as more people travel, more people go to work. Jim Bianco was on Macro Voices last night. Excellent episode, obviously. He was saying Chinese people have the longest commute times in all of the world. So if these people start driving again, you will see a lot more energy demand than I think is currently priced in terms of the contango we're seeing in crude oil markets. So anyway, lastly, getting to my free daily alpha tab, where we have 300 ETFs here, all representing individual factor exposures, trying to sort by the odds column, give you a sense of what's most overbought, most oversold out there in global macro. Nothing particularly overbought here. Most oversold, Finland. If you want to go buy Finland, be my guest. I'm not. Telecom ETF. A lot of folks are nervous about the 2023 recession, et cetera. For those of you who are long-only investors, RA-style investors, kind of asset allocator investors, this would be one of those kind of factor exposures that you would expect to perform in a deflation grid regime, both in terms of the U.S. and global economy next year. So, not telling you we're not increase your exposure to equities, but certainly if you're long equities, make sure you're in the right sectors and style factors to risk manage what could be a global recession in 2023, a rolling global recession in 2023, depending on where you live, where your geography, where your domicile is. So with that, no, I went a little long today, but guess what? Everyone likes to learn. Everyone likes the free education we give out here. So I'm going to keep doing it. And we appreciate you for tuning in. Catch you back here next week. Cheers.